Since 2009, people have learned one thing, and that is take the maximum amount of risk because somebody's going to bail you out. Today, however, things could be changing. You look at number one, the fact that 7 out of 10 people living paycheck to paycheck. This is very worrisome, especially as interest rates rise. The second thing, today we have to talk about the euro going wild. What's happening in Europe as it relates to debt? My friends, stay tuned for that. And the third, is the market entering a state of calm or is it the complete opposite? I'm going to show you tons of charts surrounding that and so much more. Let's begin. I wanted to begin right here. We are looking at hard times, 7 in 10 Americans saying that they are living paycheck to paycheck now. As always, this is a survey. It's a little tiny snippet. It's not the entire United States, but it does give us a good idea because I have shown similar studies that have been done all over the place, and it's basically the same thing every time. One time it's 68%, the next time it's 72%. It all depends, but you look at it on a generalized level, and the vast majority of people, they live paycheck to paycheck. And while debt is cheap, that makes it possible to do. But what happens when debt becomes more expensive? Then we have a problem. So that is the discussion for today. I mean, you could look at the details, and certainly it's what you expect. But when we break it down further, as we will in this Money GPS episode, I assure you it's going to be incredibly clear what this all means. Now you look at what's happening in Canada, it's the same thing as the United States, but in some ways on a more extreme level. Canadians deepen faith in red-hot housing market while rate hikes loom. The expectation is that in March, you will see the first rate hike coming out of the Bank of Canada. They have already done their QT. We'll talk about QT more in this episode towards the end of this. What is that? Quantitative tightening. That is printing money, quantitative easing, and now they have run that back. And now we are going to experience a rate hike. 64% expect real estate prices to rise over the next half year. There has never been a person, this actually must be an incorrect statistic because in Canada, nobody believes that real estate will ever stop rising. So that's a whole different story. This is important because if you look at what's happening, it's a global issue. We've never seen this before. RBA could hike interest rates anytime from June. This is the Reserve Bank of Australia doing the same thing. Look at what's happening with inflation. One example, China battles to contain coal price surge as dependency worsens. This is coming at a time in which everything is more expensive. But, as they say, who stands to gain? Who benefits? Tyson Foods scores an earnings beat on higher beef and chicken prices. The stock jumps. So there are certain companies out there that are doing better than ever before. And then you have the investors in those companies that are able to reap the rewards. The general public may not own Tyson Foods. So they may not have contributed to that. And they don't have a way of, understanding all this information. But that's what I'm trying to do. Here's the data. This is what's happening. And here is the breakdown of that. Not what's the PE ratio. No, what does it really mean? So you could see that for yourself. This right here, I know it's small font. Let me just get to the gist of this. Inflation concerns by income. Morgan Stanley, okay? Inflation as the number one concern by income, showing the comparison November of last year, 2021, to February 2022. And I'll bring the highlighter up for this. Take a look. So the blue is last year, and then, think about it, just a few months ago. And the yellowish line, that's this year. So in just a few months, we have definitely seen increases. But look at this. People making $50,000 to $75,000 a year are suddenly more concerned. And this as well. $100,000 to $150,000 a year. Those people have become increasingly concerned about income and, of course, inflation. Not good, right? What's happening with debt? This is the revolving credit monthly change. This has actually declined. I'm going to follow this really closely to see if it's a trend or a one-off. But that's interesting. And you look at both, I know again, font is small, really quickly. This is the revolving credit and the non-revolving credit, both of which have declined. So I think it's important to study this, to look at what's happening with debt, because the US consumer is the entire engine of the economy, and that is very worrisome if people are spending less money. Now let's take a look. Let's go into what's happening in Europe. Stick with me here. You've seen rates rising, and this is, of course, a big issue for countries that are in debt. Here we are seeing Italy, Spain, Portugal, Ireland, and France. But you look at the very top, certainly Italy and Spain, as well as Portugal, being a big problem. How can they ever deal with higher interest rates, higher levels of inflation? I don't know. Of course, in some sense of the word, they could use more inflation, but it's going to impact people negatively when we see what's happening here, and I'll get to that more in a second. Euro redenomination risk. This is basically just suggesting countries going away from the euro currency. That continues, as you have problems, that continues to be an issue for these indebted countries, like Italy and Spain. This is an ex-JP Morgan individual just saying right here, if you are not scared here, it's because you have no experience and have not experienced what could happen before. That's the kindest way I can put it. I am scared and I have nearly 40 years of trading experience. All that I can say is that tail risk is currently massive. And so people should be paying attention. They should be watching out. But of course, they never are. Now let's go a little bit further. I want to get into the chart GPS. I want to take a look at this. I want to be really fast. Take a look right here. In aggregate, QE holdings will peak during summer 2022. What would happen if they started to wind down these balance sheets? Wouldn't that be an issue? We're at the absolute peak right now, and if you compare it to 2018, well, then probably not so good. Some believe that they'll just continue to expand their balance sheets forever and ever and ever. We'll see in time. Historical tightening cycles and change in the Fed funds rate, just looking at what happens with stocks as a result. I'm not going to be able to get into all of these charts. There's just too much detail within them. But I know some people have been wondering what happens during the tightening cycles. So I'll show you this in one chart. There's a few. And it makes the point right here. No consistent relationship between the pace of hiking cycles and absolute returns for small and large caps. And no consistent relationship between the pace of hiking and small caps relative returns versus large caps. No matter how you look at it, they're saying it doesn't matter what happens with the Fed and their tightening cycle. Well, it's going to be other factors that determine that. That's what this data is suggesting. Based on the historical relationship, tapering and QT point to a muted plus 1.5-year return through 2024. Basically what they're saying here, the whole premise of this, is that rate hikes, you can have interest rates going up and the stock market can follow. But if there's quantitative tightening, that's going to have a major impact. Okay? I don't know what's going to happen. I have no idea. Okay? I can show you the data. We could look at it and try to make some sense of it. Earnings explain nearly 50% of the market returns prior to the global financial crisis. This is just showing us that. 1997 to 2009, 48%, but now 21%. And it just goes on, okay? Things have changed. That's all we need to know. Things have changed from this point on. And what does that mean? Of course, that as we enter a time in which there is more and more reliance on the Federal Reserve, their actions mean more. Quantitative tightening being a big one. We are expecting the rate hike. Like I've said many times before, March, they hike rates. Do you think that the market is just going to go take a nosedive from that point on? I really don't think so. Okay, the market has already been reacting to this, knowing that this is coming. But it's not necessarily a bullish thing, okay, to see that happen. This is just showing us on a short-term scale a decoupling from NASDAQ and Bitcoin. You've looked at what has happened here with the NASDAQ not performing very well, but we compare that with Bitcoin, which has gone, the last time I checked, it was at 44,000. So it has come up considerably from this recent bottom. Speaking of Bitcoin, KPMG Canada adds Bitcoin and Ethereum to corporate balance sheets, saying that this is the norm now. They're basically saying that, all these big companies, they're going to start buying it, they're going to add it to their balance sheets, and this is just going to be the way it is. The more institutional investors get in on this, of course, the longer we can expect there to be stability. That's what you want. You don't want these huge sell-offs of 60,000 down to 30,000. If this is going to be treated a lot more like any other asset, you need to have more stability. And I do think that actually that having these big institutions in there saying and committing to, okay, we're going to have 1% of our total assets to be in Bitcoin or Ethereum or what have you, I think that could bring in some stability. We'll see what happens. I think it's important, of course, as always, to be aware of what's happening on a deeper level. And that I always point to this. I'm going to leave you with this at the end. The ridiculous amount of money that has been pumped into the system. It's showing us here $4.6 trillion in Fed balance sheet and $6 trillion in M2 since 2019. That, my friends, is the most important thing you could pay attention to. The U.S. consumer and U.S. corporates hold a record $19 trillion in cash. That's a 35% increase versus 2019. Part of that, what needs to be understood, is that because debt is so cheap, you've got a company like Apple that sits on $200 billion of cash, and yet they borrow at the same time. It's crazy, to say the least. Okay, I'm going to end it there. If you found it informative, hit that thumbs up button, not once, not twice, but thrice. You got to do so. It's right down there. It supports the channel. When you do, you're actually helping the algorithm to notify people out there so that these videos maybe, just maybe, might show up to strangers. So thank you for that. If you haven't seen this video yet, you got to check it out, all right? So just click it and I'll see you there.